Well, thank you for everybody for joining. Welcome. Thank you for joining us for today's webinar, the 2024 Outlook, 3 things home equity lenders should know now. Your hosts today are Richard Martin, Director of Home Lending, Kinley Hicks, Home Equity Market Analyst, and myself, Ken Flaherty, Manager in Home Equity. As the industry's leading provider of data, analytics, and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have any questions during today's presentation, please type them into the question box in your GoToWebinar control panel, which selfishly, I highly recommend that you do. Today's webinar is being recorded, and we will be sending the recording via email post-webinar, along with a survey of today's webinar. All right, Rich, let's go ahead and kick things off.
Thanks, Ken. Good afternoon, all. We appreciate everybody joining today. So a little bit about Curinos. We've got a blend of current clients and then folks that might be new to Curinos. So a little bit about the firm before Kinley dives into our first topic of the day. As I mentioned, Curinos, our main mission is to enable clients to be more effective in executing strategy, and that's around acquiring, retaining, and growing profitable customer relationships. We do this here by providing kind of 4 main pillars: proprietary market and competitive data at unprecedented scale, allowing you ability to quantify your market position, understand your performance; deep cross-bank analytics and behavioral insights. So while we'll be covering just home equity today, we have full balance sheet solutions around things on deposits, as well as lending, as well as decision support tools and access to subject matter experts. So like Ken, Kinley, myself, many of the folks on our side have sat in similar seats or roles as to many of you on the phone today. And then lastly, we do a fair bit in marketing tools and personalization, so you can really optimize your customer's multi-channel experience. So focus of today, as we mentioned, is going to be on home equity and really 3 things we feel you need to know going into 2024. It's an exciting time, we all agree, for home equity. So what we'll focus on with today's webinar, be focusing first on customer behavior, right? Understanding that customer. Was that customer different from a home equity profile versus, say, your typical deposit customers? Are we seeing customers become more or less comfortable with debt, right? We're seeing household debt levels rise, but sort of what's that inflection point or forecasted change there? We'll take a lens and view into emerging risk, right? So as you're taking on new applications and bookings, what's that emerging risk potentially? What are patterns we're seeing in that data? With our portfolio data, we're able to track things like delinquency rates. So what are we seeing with the view into delinquency, kind of potentially a tipping point there, and then certainly on what's the horizon as we go into 2024. And then I think a great segue is sort of our last session covering around forecasting. So we are thrilled at Curinos to be bringing the first home equity forecast to market. So as everyone looks into next year, what's different about 2024 in terms of that outlook? Are we expecting some similar downturn to what we saw in 2023? Are we expecting a return to some of the lift we saw in growth in 2022? And so what does that look like both at a national level and perhaps at a more regional level? So with that, I will get us started and turn it over on customer behavior trends to Kinley.
Awesome. Good afternoon, everybody. Thank you for joining, especially given all the hustle and the bustle of the holiday season. To start off this webinar and the customer behavior trends section, I would like to discuss some trends that we are seeing in the second lien home equity loan space over the past couple of years. So as prime rate has continued to grow, consumers have shown an increasing preference for second lien HELOAN products, with a 62% growth rate over 2022 and a 34% growth rate year to date in 2023. These customers are likely risk averse, so they're not really willing to risk a floating rate product like a HELOC, especially with the shroud of uncertainty of where rates are going to fall over the next few years. They also have a higher need likely for immediate cash flow rather than looking to open up just a rainy day HELOC fund, right? More interestingly, longer term loans continue to be the most popular, with 26 to 30-year terms making up anywhere from 60 to 70% of total production on any given month. This indicates that folks are seeking out some payment relief as well, but it could be a cause in the future for refinancing concern as/if rates begin to fall in the coming years. So on that note, I will transition to Rich to kick us off with our first poll question of the day.
Fantastic. Thanks, Kinley. So first poll question, and keep in mind for those of you, you'll see the poll question come up on your screen, so you can submit your answer there. But our first question, will closed-end home equity loan demand, so much as we saw in that prior chart, continue to grow in 2024, or will we reverse course? Response 1, we will expect to see continued growth. Response 2, demand will shift, and thus we'll see home equity loan demand decline.
We'll give that a couple seconds here for everyone to cast their vote. I find it continue to be fascinated with the stat that Kinley threw out there of it's not just that we're seeing the growth, but the longer term HE loans. And again, it's second lien HE loans that we're focusing on here that are really driving a lot of that demand. But customers are offsetting, I'd rather have a flexible or a fixed payment than a flexible payment. So the results are pretty overwhelmingly, home equity loans will continue to see growth. So 75% of you feel that we'll continue to see growth next year. I don't doubt that, and I feel like I would side with that, is that's customarily where we've seen. The question will be, how will that be tilted if we do see some rate relief next year? Will customers start to migrate back maybe to HELOCs and more flexible payments? So we're going to touch more on those home equity loans here in the next couple of slides, at least later in the conversation. But Kinley, back to you.
Thank you. Zooming out, I think back to a more broad look. So zooming out from HE loans, specific trends, we do continue to see massive growth in tappable equity, with the market sitting at about 30 billion plus. I mean, you can tell that curve has been increasing for the past decade or so, but it's been a bit amplified over the past couple of years. Additionally, we are continuing to see rises in overall debt levels, the most noticeable being student loans and auto loans. However, even with such large amounts of tappable equity available and growing overall debt levels, customers are not really turning to their equity as a source of funds. Instead, we are seeing consumers increasingly turning to credit cards, with balances showing about a 28% growth rate since 2020. This is likely due to a number of factors, not least of which is ease of access. As the rates of pre-approvals and fully digital processes become the norm with credit cards, it has become easier than ever to get a credit account. However, when consumers are asked, credit is still perceived as difficult to access, which is likely driving fewer people to bother inquiring about forms of credit with higher barriers to entry, such as home equity products. Rich, if you don't mind jumping to the next slide. So, something special that I don't think anybody has seen before, utilizing our shopper survey data, which is fielded every year as a pulse check on how consumers perceive the banking industry and the products they currently have with individual institutions, we are able to segment folks who currently have an active home equity product. What's interesting about these consumers is that they tend to be slightly older, about 35 years old, indicating people are both waiting longer in life to purchase a home, as well as to draw on their home's equity. And that partially could be just the lack of affordability and how things have gotten more expensive over the years, but we are seeing that people are starting to wait longer in life to draw on their home's equity. Additionally, on average, they don't tend to have enough cash balances to pay off their total debt balances at once. And despite having access to a home equity product, about half don't always pay off their credit card balances every month. To me, that indicates a couple of things. One, these folks may just not understand how the home equity product they have works, and fear utilizing too much may drive their credit score down, which would pair well with the average utilization rates we see in our benchmark data for HELOCs, which sit right at about 30%. Two, people with a home equity product may think that it can only be used for home improvements and haven't started thinking of it or using it as a method for debt consolidation. Or three, and probably one of the more likely options, there is a perception that credit card debt is temporary, and if I can't pay it off this month, I'll definitely be able to pay it off next month, which it then results in a bit of a stuck cycle where balances do continue to accrue. Another reason why folks may prefer to use a credit card over their home equity product could be the result of lower standards of digital capabilities on the home equity side when compared to the investments in digital innovation for both credit cards as well as deposit accounts.
So let's pause there for a second. And two things I wanted to call out here that Kinley walked through. Number one, depends on who reads the slide. Kinley said older people at 35 years old. If I were to read the slide, I would say it's younger people at 35 years old. So just want to set the record straight there. But the second thing that I found interesting here is, maybe Kinley, you can elaborate. So right in the middle, you have average cash balance of that borrower, 44,000. Seems, pretty significant. With the secondary of percent with less than 25K in total deposits is the larger majority, about 2/3. So that to me kind of tells us that there's a large segment of borrowers or existing home equity borrowers that have vast amounts of wealth, that have way larger balances, that are skewing that up to that 44,000, when 65% of them are saying that they have less than 25,000 in total deposits. That tells me that for the most part, there's a lot of borrowers that are skewing that scale that have more robust cash deposits on hand. That also might be indicating why we're seeing some of the lethargic balance levels in home equity, lower utilization rates. We're not seeing as much take rates on initial utilization. But above all, and we're going to share here in a couple of slides, above all, we're just seeing balances and total home equity balances come down. Not just this year, not just last year, we're talking almost 12 years of consistent year-over-year balance declines. Rich or Kinley, like, any other thoughts here? Like, what's the main thing that grabs you here when you think about who actually has a home equity product in their wallet right now, as combined with some of those balances that we're seeing declining? Do we just have a mismatch of, we're giving credit to really good credit customers that have really good deposits that don't utilize, or are we missing something here?
Yeah, I think it's more of the former, Ken, right? And we go back to understanding your customer. I think the broader trend, that Kinley touched on is, it's not saying, if we think back in, baby boomer generation, right? A little bit older, typical average homeowner, 40% of homeowners right now own their home outright. I think that's more of that demographic than maybe this 35-year-old homeowner, kind of more tenured, homeowner. But yeah, it's kind of like the space and understanding of what's different about it. They're still purchasing homes. I think the dream of home ownership for Americans is very much still there, right? But it's happening later in life than it traditionally has in past cycles and in past demographics. So I think it's key on that understanding. We don't expect a different trend. It's just that formation, there's kind of that deferment, right? And that formation happening later.
Yeah, well said.
Yeah, and I think when you think about folks who sit in that 35-year age range, you're still seeing folks, 65% of the people who have a home equity product make less than $100,000 in income. So it's not like there's a ton of cash coming in through the door, that even if they don't have a lot of cash balances, they probably still wouldn't be able to pay off all of their debt in one fell swoop.
Yep. And I think too, Ken, kind of a final cut, the education piece is imperative, right? We talk about it all the time with our clients, is, does the average consumer understand home equity and the product, right? Like, how is it viewed? It's nuanced, but in often cases, it's much more favorable. We saw in the credit card balance, it's certainly drawing against a line of credit versus a credit card, right? Understanding the economics, but also the features of that, right? What does it mean to draw? Is it tax-free? What are those implications, right? How soon do I have to pay it back? So, we tout it often with clients, but that consumer education piece is huge.
So this is going to be looking just at specifically folks shopping for checking accounts. So it's going to be deposit specific, using the same data set as before. When polled, checking account customers have been increasingly likely to say that both their preferred method of account opening as well as their actual method of account opening is through digital channels. And this is at the direct expense of account openings through branch channels, which have shown declines over the past 4 years, accounting for only about a quarter of 2022 openings, whereas digital methods have grown to nearly 70% of net openings. So you might be asking, why are you showing me this? What does this matter? So what does this mean for home equity and home lending products as a whole? It's no secret that innovation happens on the deposit side first. It's especially in the current rate environment. However, as consumers become less and less amenable to inconveniences such as traveling to a bank branch, thank you, COVID, for speeding that evolution up. If traditional brick and mortar institutions don't maybe start innovating in the home lending space parallel to their deposits investments, consumers may begin to look to other institutions such as fintechs who already have these digital tools built out.
But before we move on, Rich, if we can back up a slide, we had a question that came in that Kinley, I want you to address. Question was, in that average debt balance, could you clarify, is the average debt balance excluding primary mortgages?
Yes, so the average debt balance is going to be inclusive across all of the debt balances. And so I think the best way to explain that is looking at the midpoint average is going to include people who own their homes outright. And so you might have some people with really low balances skewing it lower, and some people with really high balances that could skew it higher. So a bit of a, just like paying attention to, it is including people who own their homes outright.
Okay, great point.
Yeah, and I think we also had another question in on a plan to add 2023 deposit balances. I think the short answer is yes, but we can certainly take that offline and follow up.
Cool. Rich, if we don't mind moving to the next. All right. The final point that I will make on survey level customer preference data is that the highest growth in what makes a consumer find an institution convenient for their needs over the past decade is having useful and reliable online banking capabilities. This is important because perceived convenience is one of the biggest acquisition drivers, and it can also create much stickier customers than if you were to simply acquire them by having the most competitive rates at the time, or if you have a big marketing campaign at one point in time, so you're just top of mind for the moment. And this is not something that's only occurring on one side of the business. This is not just siloed to deposits or credit cards. Since 2019, we have been seeing higher penetration of home equity bookings come through centralized non-branch channels, which, as a caveat, is inclusive of both digital methods and centralized call centers. But despite the fact that home equity bookings have not reached that same 70% fully digital penetration level, that is where we believe that the industry is headed. So I would love to hear some of y'all's perspective on the importance of digital lending capabilities. So on that note, I will pass it off to Rich for another poll question.
Great, thanks, Kinley. All right, so on the topic of digital lending, poll question 2, how are you competing today when it comes to digital lending? So 1, you already have digital in place, kind of cross that off the list, competing with fintechs, banks, and credit unions. Option 2, currently planning to expand digital capabilities with the focus of doing that next year in terms of 2024. And last option, no plans presently, but hope to have digital strategy in place in the future. So something beyond a 2024 timeline.
What do we got, Kinley?
All right, it looks like we're split almost 50-50 with half of the folks saying they already have digital in place, and then 44% of folks saying that they're currently planning to expand digital capabilities in 2024. You'll hear me, I'll tout that that's a good idea. I am a big supporter of digital capabilities and moving towards that, because you think about folks who COVID happened, they went fully remote, you sit at home all day. Like, if I'm not hybrid and I'm not going back to the office, it's a lot less convenient now than it used to be to just pop out during lunch and go to a bank branch. Like, it's a lot easier and more convenient if I'm fully remote or hybrid to just do it online. And I don't think that that's going to change. I think now that people have proven that they can work from home and that remote works, that there's not really ever going to be a movement back to using branches and being in person as much as it was before.
Yeah.
So the one piece Rich mentioned earlier, on the education, again, we talk about that all the time. We're a firm believer in educating not just new borrowers, but existing HELOC customers on how a HELOC can be used. I think a lot of that goes hand in hand as I think as an industry, we face additional risk, as borrowers, customers are shifting more towards I want digital banking. I don't want to have to go into a branch or talk to anybody. I want to be able to do this myself from my own home. It's not a matter of if, but when do we get, similar to deposits, closer to, 2/3 to 75%. But as that shifts more and more, we're removing that element of that subject matter expert educating the borrower on here's what products are available, here's the best solution for you, here's how a home equity or the equity in your home can be used as a tool for you. And a lot of times is one of the smartest tools that you could leverage. So it's a matter of how quickly can we shift digital, but how can we supplement that with better education to borrowers on how do you digitally reach the borrower, but educate them at the same time, allowing them to make the best decision for their financial goals while informing them that home equity can be used for a multitude of different things, not just today, but 3 years from now, 5 years from now, as you're taking out this revolving line of credit. So while we're encouraged to see the shift, and now over 50% of home equity originations in the centralized space or the non-branch dependent, it's a matter of how quickly is that going to continue to evolve, but a matter of how are we going to supplement a lot of that non-touch type of application experience to more educational experience.
Yeah, if anybody wants to take out a Super Bowl ad, we'll all be watching.
Exactly. Ken, we did have a question come in. I think I just referenced that we had a little over half of those attendees answer that last poll question. So there was a question on how many folks are on the call to kind of better understand. So we've got roughly about 120 folks, it looks like, on the webinar at the moment. So just to help interpret. I would say, I don't think I was surprised that a quick comment from I said, 95% either already having or currently planning to expand. I think that 44% saying currently planning to expand is particularly interesting and certainly where we have expertise on that digital transformation, that customer journey at Curinos. So I guess encouraging to see, right, 95% if you factor in the first two responses, but more than I probably would have expected in terms of currently planning to expand. So, all right, now into kind of the second section of the webinar in terms of emerging risk. And so with that, I'll turn it over to you, Ken.
Thanks, Rich. So I don't think we could have a home equity webinar without talking a little bit about risk. I would say it's virtually on most calls we have with clients is always coming up on, hey, what are we seeing? What trends are we seeing? And what better time to talk about emerging risk or just kind of risk, the risk lens in general with our attendees here. So we want to talk about kind of some exterior factors first and leveraging some insights from the New York Fed in partnership with Equifax, really trying to set the tone of we kind of a gauge on what's happening from real estate secured loans, home equity included, but what's happening out there from the other lines of business. So you kind of have a snapshot going back close to 20 years or so, or 20 years, and it's showing what did, I don't know, should I call them normal activity? What does activity look like 5 years ago, 10 years ago, 15 years ago, and as compared to today? So I think you hear a lot from headline perspective. You see in those blue and green lines, that's going to be your auto loans and credit cards. You see those steep lines going upward there, and that's what everybody's kind of getting nervous about and talking about. I tend to look at this as, yes, that's a concern. And generally from a order of default, you see credit cards and auto loans and unsecured type loans default first before someone stops paying on their mortgage. So we're certainly seeing that today, but it's a matter of contrast of let's look at pre-pandemic, We're currently sitting at what look like normalized levels dating from 2011, 2012, all the way through 2020. Looked relatively flat, a little bit of increase there on credit cards towards 17 and 18. But we're facing kind of similar active delinquency rates on those lines of business. But again, it just feels more severe given how quickly we've increased. It's more of a matter on a lot of our clients' minds and a lot of our partners is this just the start? What's around the corner? When's the other shoe going to drop? And we'll continue to see higher delinquencies and what's around the corner for real estate secured loans, such as home equities and mortgage. So you see on that bottom right-hand side, the purple line, it's going to be home equity revolving. Then you have yellow and mortgage. Again, this doesn't look like a normal environment. The question that we're kind of touting here is, are we abnormally low? Are we due for a correction? Now, I can say I have sat in credit risk meetings before and had the uncomfortable conversation of delinquency rose 10 basis points from last quarter. What are we going to do to stop the bleeding? I was always the same person in the room that would say 10 basis points and we're still super low. Do we really need to have a knee-jerk reaction and say, yes, we have a problem? Or do we look at this as we're more normalizing? We've been abnormally low. Can we expect abnormally low delinquency levels forever? At some point, we're going to see a correction. And is it really a correction, or is it just more of coming back up to normalized levels? Real quickly, on the right-hand side, we thought this was super interesting. This is looking at that debt share by product and age. Won't go through all of the details there, but kind of similar, tying back to a similar slide that Kinley walked through. And what is that profile of a home equity customer look like, kind of with that median age range of 35 years old? So that's going to be kind of in that second and third line. Let's call it the 30 to 49 range, just to be fair. But looking at that debt load of vastly weighted towards mortgage debt there in orange. Then you see behind that, you see kind of a tied competition between auto loans and some student loan debt there in the 40 to 49. But across the spectrum, you don't see HELOC show up until you get into the 70 plus range. As we think about who's buying HELOCs today and the distribution of debt, this starts to make a little bit more sense to me. You have 70 plus, 60 to 69 with the heaviest distribution in home equity debt, followed by, then you have credit card debt. Then you look at that person, the average profile customer in kind of the younger generation in the 30 to 50 range with, I don't even really see it much show up on the radar in terms of the distribution and their HELOC balances. This is really the main focal point of what's causing balances to shift. We're seeing a shift in that average profile of that borrower. And as a result, younger generations are using home equities different. They're using them differently at the point of sale, and they're having faster prepayment speeds, much different than what we've seen from older vintages. So we're going to dig in a little bit more around this concept of balance growth and organic balance growth and some of those challenges there. But just wanted to preface a lot of what we've been seeing, what that profile looks like, what delinquencies look like in other lines of business, to this slide, which is now leveraging Curinos data in our portfolio consortium. So a similar snapshot looking back to 2012 to present, you see similar to what we showed on the Equifax view, see that steep downturn after about 2012 and 13. So you kind of see what feels like has been a normal environment for a number of years. And we've continued to see improvements really post-pandemic and kind of coming back to normalized levels on both the HELOC and the home equity loan. Now, one additional thing I will call out is home equity loans, the data is accurate, but what I wanted to preface that with is home equity loans look almost too good. But you have to remember how much business a lot of you originated just in the last 24 months. really you can probably narrow that to 18 months. So a lot of those home equity loans have been on your books for a very short amount of time. So we haven't really fully seen a lot of those loans season yet, in which normally we start to see active delinquencies start to take off after about 36 to 48 months on books. So I'm prefacing that with they look really, really low. They're all performing really well, but we do expect to start to see those increase, keeping all macroeconomic levels kind of flat. Just the normalcy of those delinquency levels are just inherently going to increase because the newness of those recent vintages and the distribution that's very heavily weighted between 2020 and 2022 just hasn't seasoned out yet enough. But outside of that commentary, we feel really good on where we're sitting from delinquency. We don't see anything popping off the page here of lenders need to take a time out. We need to take a look at some of the strategies, and we need to get a bit more precise in the credit strategy because of impending emerging risk. If we jump to the next slide, Rich, we're going to take just a slightly deeper look at that. We've shortened the time frame a little bit for you, but what we wanted to break out is, again, are we seeing signs of normalcy, but are there pockets in which we are seeing increased delinquencies looking at by different credit deciles or how you would formally look at credit risk in your book? So on the left-hand side, you have second lien HELOC delinquencies by credit score. In the middle, you have by HELOC utilization rate. And then on the last box, you have by CLTV, so it's going to be for your combined loan to value. So the first thing that hits me when I look at this slide is it looks flat. I really don't see anything that pops off the page here. We won't stop there. We'll dig a little bit here, but there's not much to be dug up. This is just by order of default and likelihood of default. You're seeing the normal delinquency levels based upon risk severity. So on the left-hand side, the less than 660, we see at the highest elevated levels of active delinquency, seeing a little bit of uptick there. With the rest of the credit profiles that are the different credit deciles, flat to maybe the tail slightly increasing by a basis point or two. But really in this 12-month snapshot, we're not seeing anything jump off the page of there's a certain credit score profile borrower that is behaving differently than another. We're going to look at this by vintage in a second. That tells a little bit of a different story. But all in all, credit score profiles behaving somewhat normally. When you look at this by utilization rate, as a customer is more heavily leveraged or utilized on their HELOC, we tend to see historically through presently, the likelihood of default increases. So you see a huge delta there between someone that has greater than 95% utilization with much higher delinquency rates as compared to the segments that are under 95 and certainly even further down once you go to the 1 to 30, so the very low utilizers. And then lastly, by combined loan to value, obviously the perception of borrowers as I feel like I'm closer to or possibly underwater on my home, the higher likelihood of default. We're certainly not seeing any emerging trends there that would dictate that borrowers are behaving differently across all of these different credit lenses.
Yeah, and Ken, I think another explanatory variable that you don't see on the page is the stakes are higher now, right? You think about these second lien folks, I'm not willing to risk my home. The rates were the lowest that they had ever been, and they probably won't go back down to as low as they were for mortgages in a long time. So unless I cannot pay, I absolutely have no ability to pay. This is the last thing I'm going to default on because folks understand the stakes and they couldn't afford their home at current interest rates most likely. So it's delinquency rates probably are going to be flat for a while.
Yeah, 100%. There's too much skin in the game at this point. There was a stat, and I'm probably going to kill this stat. There was an article that came out, it was just yesterday, that it showed, of those that are delinquent, just how much are they potentially leaving on the table if in fact they do default and they are foreclosed. It's a staggering number. but that's kind of intuitive of there's just so much tappable equity that you even showed earlier, Kinley, of it's not just, we have good macroeconomic levers that are moving in our direction, or at least in our favor right now, but borrowers have a different outlook on their home. And why would you give up your 3% rate and the 30% in equity that you're currently sitting on in your home?
Yeah, it's the saying, you're gonna bury me in this house now. It's not a starter home anymore.
What's the
All
saying, Ken? The love the home, date the rate, right? Is that the mantra?
Right. Yeah. I love that.
I'm gonna pause, so we're a little over 30 minutes in, but we had a few questions come in maybe before we continue this section, but Ken, specific to kind of these views, maybe one for you. Is credit score we're looking at here at time of origination, or is it most recent in terms of that credit has been refreshed?
Great question. So what we're looking at here is the origination score. So we do get refreshed credit scores just to keep everything sound. We continue to use origination for this specific view. I think where this particular individual is going might be thinking is how much has implications of credit migration may have impacted this, and do you see any shifts from origination to current credit score that might show some different paths? We think if we would see a better indicator on rising delinquencies in one single tranche, then I think that would certainly make sense to dig a little bit deeper. But again, with the exception of the originating credit scores less than 660, that's where they started. That's how they're behaving in those expected delinquency rates. So yeah, thank you for the question.
Yeah, and we had another one I think you'll get to, Ken, on the next slide, but asking about delinquency trends. Is it safe to expect levels to go back to pre-COVID? I think our vintage stuff might play out some of that. So I'll tease that question for maybe the next slide. And then we did have a question on going back to the distribution of credit around mortgage, obviously showing as the largest loan concentration or distribution. Do we know what percentage of homeowners typically have already paid off the mortgage? As we all know, LTV, CLTV being key for home equity pricing. So I can give the short answer to that of yes, we have ability to stratify by LTV, CLTV. I mentioned earlier on the call kind of a general statistic of a near an all-time high, roughly 40% of all homeowners owning their homes free and clear. So, but again, certainly within the data, we can stratify that from an LTV if it's mortgage, CLTV if you're specific to looking at equity. And then it looks like one other question, Ken, I'll get back. Do we have this data greater than 1 year? I think the answer is yes.
Yeah, I think we wanted to fit a bunch of stuff on a page and not have everybody's eyes go crossed. But as you recall from 2 slides ago, our delinquency or portfolio snapshots begin as of January of 2012 with vintages back to the early 2000s. So the question that was asked earlier on what do we expect in terms of delinquencies? Are they going to go back to pre-COVID levels? Let me maybe indirectly answer that question and talk about what we see on this page. So what we're looking at is by month on books. So you have M0 that'll be funding, and then you have all the months coinciding after. And then you have the different lines there that are going to indicate that particular yearly vintage. So let's just play the normalcy game here. If you look at 2015 and 18, you kind of see some different observations. With 15, you're just kind of seeing a much more flat line, but on the tail, starting to see increases. 2018, you see the big hump there in the middle. A lot of that is the result of based upon how long have they been on books. Let's see, that was right around 2 years on book, roughly. So that would put them about 2020. We know what happened in 2020, and then that's come back down. I think the biggest takeaway for me here that we've kind of circled there in that bottom left is the 23 vintage. And I would say if your one takeaway here for this section, it's going to be the active delinquency rate only through month 9 on books. Now, keep in mind, this is by month on books. So hitting that M9, that's only the January 2023 vintage that's hitting that. But the trend behind it suggests that we're on that path to a higher velocity of active delinquencies well before that portfolio ages 12 months on book. So is this a fire alarm that we're pulling? I don't think so. Is this an item that lenders should watch for and be cognizant of? Absolutely. And the reason we're framing it that way is, you have to think about that customer that took out a HELOC this year versus a couple of years ago. So if we go back to that 18 vintage, for example, those borrowers originated a HELOC at 3.25. Their monthly IO payment, assuming they're paying IO, their monthly IO payment is roughly 3x greater today than it once was when they originated. So we strongly feel a lot of those more recent delinquency are the result of the higher stressed payment. And you're seeing that in the 15 vintage as well, that's hitting 6 years on books. Or I'm sorry, 8 years on books. But if you think about the 23 vintages, borrowers originated at similar interest rates, at the start of the year as compared to today. Think about the other stressors that are impacting those borrowers. Now student loan payments are back in. Now they're feeling the effects of that Mercedes that they purchased in 2020 when they had their mortgage in forbearance and their student loans in forbearance. A lot of those factors, in addition to the higher cost of living, we feel are attributing to higher delinquency rates. That doesn't look like anything that we've seen historically from some of the older vintages. So will we flatten out next year? My hope is yes. We tend to see these curves happen again that are repeatable. So we would not expect delinquencies to begin to come back down on this vintage for several months, several quarters. Are we talking 100 basis points and higher? Time will tell. We're not on track for that for this year, obviously, but I think is something to stay cognizant of, watch for, of potential emerging risk of faster and higher levels of early default, early delinquency. I think we have one final poll question here, or sorry, we have, it's our third poll question.
We'll go in. We had 2 other questions come in. I'm going to do the poll question first, and then we can come back to those. So third poll question, what will cause home equity delinquency rates to begin increasing? Is it 1, unemployment to rise significantly? 2, borrowers deplete their other options, credit card savings levels? We're already abnormally low and delinquency is destined to rise in 2024, so maybe a bit of normalization, or 4, perhaps other prediction or causation.
So this is your chance to tell us differently. We're always open to feedback, but I think myself, Kinley, Rich, think we're on the same page there of, I think unemployment with last week's numbers coming out, coming in more favorable. That is likely a shoe to drop next year, but matter of when, but just how much of an impact will that have on delinquency? Time will tell. All right, let's go ahead and close that poll. And what's our results here? All right, so this is more of a depletion on the reason we will begin to see delinquency rates increase as the result of borrowers depleting their other options, such as their credit cards, savings accounts, and so on. That's 52% of you that are casting your vote that borrowers will deplete their other options, which will be the primary reason driving higher delinquencies. Second behind that was our third option. Sorry, that went away. We're already abnormally low. Delinquency is destined to rise. That was 26% of you. I can't discount that either. I do think we're due for a correction, using air quotes. Do you want to call it a correction? But I do think we'll see some increases. We just have to figure out how still can we sit without having a knee-jerk reaction that this is the end.
I think too, Ken, the 18%, I know it went away, the results, but 18% only unemployment to rise significantly. I think that speaks to some, the recent non-farm payrolls report, others. I mean, it's still a resilient labor market, right? Performed, I think, a lot better than many expected with some of the Fed action, but 18-ish% of the respondents, roughly about 62%, responded to the poll question, depicting, again, a fairly strong labor market. Again, wages, I think, starting to normalize, but I found that interesting. I'll let Kinley jump in the next slide. There's a few questions that came in, and just to keep us kind of moving and for sake of time, around some of those delinquency trends. Ken, I'll try to come back to that at the end, and then ultimately, if not, we can reach out to those folks directly.
Yeah, so continuing the conversation on risk, looking at average contract rates backing out to 2010, borrowers have not really seen a rate environment like the one we're in today. And rates across lien positions and both HELOCs and HELoans rarely peaked above 6 and never breached 7 until 22, 23. And people, I think, on that conversation, second lien HELOCs, we're not seeing increased delinquencies yet, but people who originated a HELOC a few years ago may now be sitting at a much higher rate than they initially originated at. So that is probably causing payment stress on that pool of people. And given Fed posturing that rates may begin to soften in the latter half of 2024, there's also the potential of flight risk as rates begin to come down and borrowers seek some payment relief, especially in those HELoan products. As we discussed earlier, there have been significant growth in second lien HELoan booking volume. So as rates soften, it may be good practice to keep a pulse check on that specific product within the portfolio. This is broken out by vintage. So looking at the benchmarking data, we do see the distribution of active units from 21 to 23 shift dramatically from a heavier weighting in sub 7% rates to a much more distributed in 7+ rates. The 23 vintage is the only vintage with active units that have more than 8% distribution in that 9% plus interest rate, and sitting at about 35%, where all the other vintages are, 7, 6, 5%. So definitely a much higher distribution in the 9% and higher interest rates. So although second lien HELoan production has been providing a lot of much needed balance growth to lenders' portfolios, if rates soften, this may begin to have the opposite effect, especially within the next 12 to 18 months. So given that in 2023, the average second lien HELoan size is about $80,000 at a 20+ year term, any runoff could potentially cause some issues to overall portfolio health in the future.
Yeah, to finish this off in this section, Kinley, it sounds like from the first poll that we took that, the consensus here is home equity loans will continue to grow. I'm not here to debate that, and I think I could get on board with that sentiment, but I think about, we've been talking to our partners a lot of, the potential emerging risk from portfolio, from the retention efforts there, as you were just referencing, of thinking about all the originations that you've done this year and really padded your portfolio, and what's lacking on HELOCs through that second lien or first lien home equity loan product. But at what point will those borrowers shift their mindset? When will it shift back to HELOC, or at least more predominantly towards HELOC? And then secondly, those same customers that took out a 9.5% second lien closed-end home equity this year, are they going to say, wait a second, rates are at 7.5 now? I'm at 7.5 on my second, and I'm at 4.5 on my first. I really only need rates to soften a little bit more in the mortgage market for me to do another total rate and term refi. So don't think we're quite there yet, and based upon Fed forecasts on rate, I don't think we'll be there for some time, but I think home equity loans certainly have a fair amount of flight risk associated with them.
Yeah, and I think you think about the psyche of the person who gets a HELoan versus a HELOC, especially now. I think you're more risk-averse people if they're sitting on the sidelines right now, like, I have my house, I have equity in my house, I'm just waiting for rates to come down. The more risk-averse people are probably not going to open a HELOC in the near future, or ever maybe, because you've seen the massive growth in rates in such a short amount of time. It's going to be, I don't want to risk that. I'm not going to be able to pay that if it goes up to 9 again. So if I see rates go down to 5, I'm locking in a HELoan. And so you think about the folks who are going to start kicking out HELoans versus HELOCs, And so it does make sense that some lenders are more bullish on the HELO loan product.
Yeah, agreed. All right, Rich, I think on to our much anticipated last section here.
Yeah, I'll let you, Ken, get your crystal ball polished for this, but certainly just a quick time check, about 10 minutes or so left in today's webinar. There's a few more questions that have trickled in, Ken. There was a general liquidity comment earlier, just around, folks seeing home equity growth, strong tappable equity, but thoughts as to general liquidity. Obviously, we've got IMBs that have entered this space, so a bit of liquidity in the securitization market, and then also if lenders are pulling back the throttle at all. So if you get a chance to answer that as part of the forecasting session, great. And again, to those, a few other questions we might not have a chance to get to, happy to follow up offline with those individuals. So with that, Ken, I'll turn it over to you.
Great. Yeah, I don't think we'll get to all of them, but hopefully through some of the commentary here, I will at least partially address. We're going to move quick here so we can cover this, because we know that a lot of you, are anxious to hear about Curinos's introduction to home equity forecasting. Quick history lesson here before we jump in. So flipping from the portfolio data back to origination. So this is leveraging Curinos's home equity origination data assets. So just kind of looking at the volume of booking trends from 2010 to present. Again, 16, 17 was kind of the peak years. A big bulk of that was the result of end of draws from 2005 through 7 coming due. We think we'll hit that again in 2025 and 26 as those 10-year end of draws come due. But, look at volume since 2017, look how that's come down. But also drawing your attention to, the big growth that we saw in 2022 to the downturn that we're seeing in 2023. I think if we all had to sit here on a call 12 months ago, who would have thought that we would have the year that we've had this year? I know that's not the same for all of you on the phone. Many of you have had very good growth years, but the vast majority in total growth, we're down almost a third year over year. So really, we can jump to the next slide, but it really kind of frames up our point here, which is having an accurate forecast matters. It matters because you need more of that expertise over intuition. Perfect example is the example earlier. If we all did sit here a year ago and say, is 23 going to be a big year? I think we could all stack hands and say, it's got to be. You have all the tailwinds. Everything's in favor for home equity. Why wouldn't we? Yet here we are with a vastly different outcome than some of that intuition that we had. That really creates havoc in terms of, hitting your budget, how you're allocating your marketing dollars, when you're spending them. And it just creates a lot of those gaps and likely pushes to next year and makes even next year that much taller of a task for you. In terms of total market strategy, having an accurate forecast matters. So again, when to spend those marketing dollars. When do you run those pricing promotions? When do you look to invest to bring better, different products, promotions into the market? When do you look at focusing on retaining customers as opposed to new originations and so on? A lot of that, a accurate forecast can help you and will matter, as opposed to just putting your thumb in the wind and saying, yeah, wind's blowing this way. That feels like what's my forecast. So that's going to be my goal for next year. And then lastly, from a importance of having an accurate forecast is understanding your expenses, having a better description on how much you're going to be spending in which quarters, correct personnel and resource allocation. When do I need to staff up or staff down? And really understanding, again, those balance, growth, and retention drivers of what times during the market do I need to really go after originations and drive balances versus times where balances are going to be lethargic. I need to focus on my book and drive more organic growth or balance retention that way. So as we let's go ahead and jump to the pinnacle slide here, Rich. Ultimately, what we're thinking for a forecast we're really impressed by the prior performance in the forecast. And so what I mean by that, what you're looking at here is Curinos's consortium data that's going to be in the black line, but Curinos's modeled forecast in the purple. So it's not a perfect model, nor should any model be perfect, but you see really, really close alignment through any quarterly decile that you see. And where you see the growth in 2022, Curinos's forecast was very accurate, getting very close to actuals. And then similarly, where we all had the intuition that 23 was going to be a banner year, yet we're seeing deceleration for this year. So what does that mean for 2024? It's a mix of two stories. We're seeing more acceleration in the second half to the tune of 5 to 15% growth in the second half of 2024. But actually, we're seeing upwards of 10 to 20% declines in the first half of the year. And many of you can see that writing on the wall as applications have sputtered. We've seen really lack of demand in applications over the last several weeks. That's not really framing up a really strong presence for Q1 originations already. So just to restate that, in case you didn't clear that, first half of next year looks really challenging. It looks extremely challenging to the tune of almost 20% declines, and this is measuring 24 forecasted performance versus first half of 23 performance. So we can see continued pressure and challenges in the market. For the second half of the year, upwards of 15% growth, H2 of 24 versus H2 of 23. The matter for you to take away from this is, what does this mean for all in 24? I'm going to have a different strategy, but what are you saying, Ken? This is going to be a challenge to have a growth year, given the downturn that we expect to see in the first half. Will the second half be enough to offset the declines that we're seeing in the first half? I think we're up for the challenge, but it will be absolutely a challenge. I think we just have time for one more here, Rich, in terms of, we can flip to the poll question here. We can go ahead and get that launched up.
Right, so our final question, kind of in the vein of forecasting, had forecasts in rear view, right? Had forecasts been available to you that forecasted a 30% market downturn, what would your institution have done differently regarding your 2023 strategy? That'd be less investment in marketing dollars, reallocated internal resources and staffing, strategize more aggressive pricing campaigns and promotions, double down, planning to beat the odds, nothing different, so kind of BAU, status quo, or perhaps something else. Ken, will we give that a chance for results? Just wanted to clarify too, this forecast we're looking at is at a national level, correct?
Correct. It is a national level. We do have the expertise in the model intelligence to do something geographically. We kind of do that on a consulting basis for our clients. If you want something specific for your Midwest or your Western markets, but what we're offering for attendees today is more the national view. All right. Okay, so what would you have done differently had you known last year what you know now? Really, really close there. 33% wins it at strategized more aggressive pricing campaigns and promotions. Behind that at 31% reallocated internal resources and staffing. The third, and I think we're all a little surprised here, the third highest is 21% of you say you wouldn't have done anything different. So I do find that surprising, but no surprise there. With the winner there, strategized more aggressive pricing campaigns and promotions to really try and tweak out just that much more volume based upon a competitive environment, but number two, a very challenged environment.
Ken, I'm going to let you end here. I know we're just about up on time, top of the hour, so I'm going to let you end here with this kind of final takeaway.
Yeah, final takeaway, and thanks for those that have stuck with us here. Final takeaway, and I wish we had more time, is are we focusing too much on originations? we've seen originations shift over the last 10 to 12 years, but at the end of the day, this slide is showing you balances continue to drop year over year over year. So my question to you in parting is, are we too focused on originations, originating the widget, when really we should be focused on looking at the dollars, looking at the balance growth, looking at borrowers already in portfolio? And I think that answer is yes. I think you can do both, but aligning your strategies for more balanced growth efforts as compared to origination dollars and commitment dollars, I think is going to be a very challenged strategy. So how do we get back to balances from 10 years ago? It's going to take a lot of clawing and digging, but I think we can get there. We saw that in Kinley's slide. The credit card balances are out there. Customers are not adverse going into debt. So I think the opportunities are there. I think we just need to be a bit more strategic.
Great, Ken. Well, again, I want to thank those that stayed an extra minute with us today. Appreciate everybody, Ken, Kinley, your participation, folks that took the time to join us today. Again, you can see our contact info on the screen. Encourage all of you to reach